Let's just jump right into it. Welcome to this explainer. If you're studying for your ACCA Financial Reporting exam, property accounting probably feels like a massive headache. There are just so many overlapping rules. So if you've read the textbook, watched a bunch of lectures, and still feel totally lost, don't worry, you're in the right place. Today, we're doing a real Accounting for Dummies style breakdown of IAS 40. We're going to use plain English, talk about the real world, and most importantly, figure out exactly why these rules actually exist, instead of just blindly memorizing them. Okay, I want you to imagine you own a standard, everyday brick building. Just 4 walls, a roof, maybe some windows. Depending entirely on you, that exact same physical structure could fall under 3 totally different sets of accounting rules. Wait, why on earth would that be? I mean, it's just a building, right? Well, here's where students usually get caught out before even looking at the numbers. The absolute secret to IAS 40 boils down to one simple economic reality. Purpose is everything. Literally. How a property is accounted for depends entirely on why your entity holds it. It has nothing to do with what it physically looks like. A building is just a building, sure, but your business intention, meaning what your board of directors actually plans to do with it to generate cash, that completely rewrites the entire accounting rulebook for that asset. So think of it like this. Here is the absolute ultimate memory hook for keeping this straight on exam day. Live, let, list. If you use the building like you live in it for your own business operations, maybe it's a busy factory or your corporate head office, that's owner-occupied under IAS 16. If you hold it to earn rent or for capital appreciation, meaning you're just letting it sit there to let its value go up over time, boom, that's an investment property under IAS 40. And if you built it or bought it specifically to sell to customers in your normal day-to-day business like a property developer, you'll list it, making it inventory under IAS 2. Let's actually test your intuition on this with a quick exam-style scenario. We'll see if you can spot an investment property out in the wild. All right, think fast. Imagine you own this empty building. No one is in it at all. But your clear, documented purpose is to find tenants to pay you rent. So which rulebook are we using here? Is it IAS 16 because it technically belongs to your company? Is it IFRS 40? Or maybe it's IFRS 5 because that's the rulebook for assets you are actively holding for sale. What do you think? If you guessed IAS 40, you hit the nail on the head. Even though the building is completely empty right now, your underlying purpose is to generate a rental return completely independently of your core business operations. And it's definitely not IFRS 5 because you aren't trying to sell the building itself in a quick one-off transaction, right? You're actively trying to lease it out over a longer period. Because the core purpose is rent, it falls perfectly under IAS 40. Now this brings us to a total classic examiner trap. What happens if a parent company rents a building to its own subsidiary? Well, in the parent's separate individual accounts, you're the landlord earning rent, so yep, it's IAS 40. But what about in the consolidated group accounts? Suddenly, it's IAS 16. Why? Well, think of the corporate group like a family. If you rent a spare bedroom to your sister, sure, you feel like a landlord. But to the outside world looking at your family as one single unit, the family is just living in its own home. You can't rent to yourself. Okay, so once we've successfully identified that we actually have an investment property, we need to figure out how to initially measure it when we buy it or when we finish building it so we can finally get it onto the balance sheet. Honestly, just treat it exactly like buying a shiny new car. Just like you'd pay registration and on-the-road costs for a vehicle, you absolutely must capitalize directly attributable transaction costs for your property. I'm talking about things like legal fees, property transfer duties, and agent commissions. A huge, and I mean huge, mistake students make under exam pressure is expensing these directly to profit or loss. Please don't do that. You got to add them directly to the starting cost of the property. Right, so after that initial recognition, IAS 40 does something pretty rare in the accounting world. It actually gives companies a genuine accounting policy choice for how to measure the property year after year. You have to choose either the fair value model or the cost model. But listen closely, because there is a strict all-or-nothing rule here. You must apply your chosen model to all of your investment properties. There is absolutely no cherry picking. Why? Well, because accounting standards really hate profit manipulation. You can't just put your spectacular, booming skyscrapers on fair value to look amazing to investors and then hide your struggling, depreciating strip malls on the cost model. It has to be consistent across the board. And guys, this is arguably the single most tested point in the whole chapter. The exact mechanical differences between IAS 40 and IAS 16. First off, what even is fair value? In plain English, it's simply what you could sell the property for today on the open market. Under the IAS 16 revaluation model, that's for owner-occupied buildings, gains go to a special equity bucket called Other Comprehensive Income, or OCI, and you still have to depreciate the building. But the IAS 40 fair value model, totally different beast. Gains and losses flow straight into your main profit or loss, and you never ever depreciate the asset. Why? Because if you are constantly updating the property to its current market value every single year, depreciating it on top of that would just be double counting the wear and tear. It makes no sense. Let's build this into a rhythm that you really need to internalize for the exam when you're dealing with the fair value model. Step 1. Build up your costs during the year. Step 2. At year end, remeasure the property to its current fair value. Step 3. Take any gain or loss straight to your main profit or loss. And Step 4. The absolute golden rule. Never, ever depreciate. Seriously, memorize that rhythm. It will save you. Now, we all know businesses change over time. Sometimes a head office gets emptied out and turned into a rental property, or a property under construction is finally completed. Because of this, we need to master the rules for transferring properties between these different accounting standards. Here's the catch. You can only account for a transfer when there is actual hard evidence of a change in use. The trigger rule is vital. Management simply intending to rent it out or chatting about it in a board meeting? Nowhere near enough. You need concrete evidence, like an actual signed lease agreement with a third party or physically taking occupation of a newly constructed building. Once that evidence trigger is met, the key concept is deemed cost. This just means the fair value of the property at the exact transfer date becomes its brand new starting cost for its new category. When you're transferring a property into the investment property category, the underlying logic is actually fantastic once it clicks. Basically, the asset keeps the personality of its origin. If it's coming from an owner-occupied state under IAS 16, it carries that IAS 16 behavior with it right up until the moment of transfer. That means any final uplift in value goes to other comprehensive income. But if it's coming from inventory under IAS 2, it carries its old profit and loss personality, so that final uplift goes straight to your main profit or loss. Eventually, of course, you're going to say goodbye to the asset and sell the property entirely. The gain or loss is super simple. It's just the net cash proceeds you receive minus your latest carrying amount on the books. And that difference goes straight to the investing category in your profit or loss statement. But wait, here's where students usually lose really easy marks. Let's say you have a leftover revaluation surplus just sitting in your equity from years ago, back when the property used to be an owner-occupied head office. When you finally sell the property, you move that surplus straight across into retained earnings. You never ever recycle it back through profit or loss. Why? Because that profit was already technically locked in during the past, so just quietly slides over into retained earnings on your balance sheet. No P&L impact today. All right, before we wrap up, let's consolidate everything we've talked about into a rapid-fire checklist of common examinator traps. I want you completely bulletproof on exam day. Let's recap the golden rules. 1. Purpose drives classification, not what the building looks like. 2. Capitalize your buying costs, like legal fees. Do not expense them. 3. If you use the fair value model, take all gains to P&L and do not depreciate the investment property. 4. Demand hard physical evidence for any transfers. 5. When you sell, any leftover surplus goes straight to retained earnings. And lastly, even if a company uses the cost model to measure its property, it still absolutely has to disclose the fair value in the notes so investors know what it's truly worth. So I'll leave you with a provocative thought to ponder as you go practice your financial reporting questions. If simply changing a property's purpose changes whether gains hit your main profit or just get quietly tucked away in equity, well, how might a company strategically change its purpose to manipulate its reported profit? Understanding why the rules exist is the absolute key to mastering how they might be bent. Thanks for joining me on this explainer, and go absolutely crush your ACCA studies.